If you've ever felt like investing is complicated, risky, or something that needs a lot of money to start, you're not alone. Maybe you've tried before, maybe you've waited, or maybe you're still unsure where to begin. The truth is, you don't need to be perfect or rich. What you need is a plan. And this guide is here to keep it smart, simple, and perfect for beginners. In this video, I'll walk you and the Money Explorers step-by-step through how to start dividend investing in 2025, even if you're starting from scratch. We'll cover what dividends are, how they work, why investors choose them, and mistakes to avoid. By the end, you'll see a real example. Investing just $7 a day and reinvesting dividends could grow into over $1.7 million in 30 years, paying about $5,000 per month. So if you've ever wondered, where do I begin? The answer starts here. Let's dive in. What is a dividend? When you buy a company's share, you own a small piece of that business. Some companies share part of their profits with shareholders. This is called a dividend. It's the company's way of saying, thanks for believing in us. Most dividends are paid quarterly and appear as real cash in your account. You can reinvest, spend, or simply save them. It's your choice. Some firms even pay monthly dividends, which can feel like a second paycheck. The best part, many companies increase their payouts year after year. That's dividend growth. Over time, this creates a snowball effect. Dividends buy more shares, which earn more dividends, which buy even more shares. That's compound growth, one of the most powerful forces in investing. Before accounts or stock picking, the first step is your mindset shift. Dividend investing isn't built for excitement. It's built for results. Think of it like planting a tree. You sow the seed, water it, protect it, and over time it grows strong enough to give fruit every season. The biggest mistake beginners make? Quitting too soon. They expect quick results, don't see much in a few months, and assume they're failing. They're not. They just didn't give it time. Dividend investing demands patience and discipline. Even small amounts, $5 or $10, stack up when reinvested. Remember, you're not trading or gambling. You're owning assets that pay again and again. The longer you stay, the more you gain, not just in money, but in confidence, stability, and financial freedom. Step 2, setting up your account. To buy dividend stocks or ETFs, you need a brokerage account. Think of it as your investment hub, where your money lives, grows, and works for you. A brokerage lets you deposit funds, buy shares, receive dividends, and reinvest them in one place. Setup is simple, and you can start with any amount. We've partnered with Moomoo, sponsor of this video. It's a free platform offering real-time data, advanced tools, and zero commission trades in an easy-to-use app. New users can earn up to $1,000 in NVDA stock with a qualified deposit, plus 8.1% APY on uninvested cash. FDIC insured up to $1 million. You also get free access to Morningstar research, analyst ratings, and premium news sources like Wall Street Journal and Bloomberg. Like the video? Hit the like button, subscribe, and comment below for more awesome content from the Money Explorers. Step 3, how to pick good dividend stocks. Not every dividend stock is a good choice. The goal isn't to chase the highest yield, but to find companies that pay consistently and grow steadily. Here's what to check. Dividend yield. Healthy range is 2% to 5%. Extremely high yields, 10 to 12%, usually signal trouble or unsustainable payouts. Payout ratio shows what portion of profits go to dividends. Too high means little left for growth. Aim for below 60%. Dividend growth. Look for companies that raise payouts every year. Over time, this boosts your yield on cost and creates strong income streams. Business strength. A dividend is only as safe as the company behind it. Focus on stable sectors like consumer staples, healthcare, banks, and utilities. Common beginner traps. Chasing giant yields, ignoring payout ratios, focusing on short-term returns, or buying businesses they don't understand. A good dividend stock should feel boring but reliable. Step 4. Once you know how to spot quality dividend stocks, it's time to build your portfolio. Think of it like building a house. Every home needs a strong foundation, then come the walls, roof, and details that make it solid and unique. For dividend investors, That foundation is usually an ETF. A broad index like the S&P 500 works for general investing, but for dividends, a dividend ETF is ideal. One of the most popular and my top choice for beginners is SCHD, Schwab US Dividend Equity ETF. It's a low-cost, beginner-friendly basket of strong dividend companies with a proven record of growth. For many new investors, SCHD alone is a great starting point, but you can add individual stocks for extra stability and growth. Examples include JP Morgan Chase, financial strength, reliable dividends; ABVI, ABBV, healthcare income plus growth; Lowe's, steady consumer demand, strong dividend history; and NetEase, global exposure, fast dividend growth. Together, these picks create diversification, stability, and growth in one portfolio. SCHD is the base. JP Morgan and Lowe's are U.S. blue chips. ABVI adds healthcare yield, and NetEase provides international growth. For the numbers, add the 5 yields equals 3.73%, plus 1.93%, plus 3.18%, plus 1.87%, plus 2.26% equals 12.97%. Divide by 5 equals 2.59% average yield. Using the same method, the portfolio's 10-year dividend growth is 15.57%, and its annual price growth is 13.99%. Great, you've built your portfolio. Now, the big question is, when the dividends start coming in, what do you actually do with them? You've got 2 choices. First, reinvest your dividends through a drip plan. Each payout automatically buys more shares, and those shares then create their own dividends, building the famous snowball effect. Small at first, but powerful over time. Second, you can take the cash, use it for bills, or treat it like a second paycheck. Retirees often rely on this for steady monthly income. Which is better? For beginners, reinvesting is smarter, letting your snowball grow. Later, when your portfolio is larger, you can switch to income. Now, imagine you invest just $7 a day, like the price of coffee. In 1 year, you'd contribute $2,555. After 10 years, it could reach $56,758. In 20 years, about $336,697. And in 30 years, nearly $1.79 million. That means roughly $61,840 per year in dividends, or $5,153 monthly, whether you're working or resting. The growth comes from 2 engines: $1.35 million from stock gains and $364,000 from reinvested dividends. That's compounding in action. Click the video to see how to make $7,000 per month with just $20 a week. You've been watching The Money Explorers, your guide to smarter money, investing, and financial freedom. Don't forget to like this video, subscribe to the channel, and follow us so you never miss the next money tip.